everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, let's do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. I see we still have some logging in, so I'll just take a minute. If you would, type OK in the question box there if you're hearing me clearly and seeing my screen all right. Okay, thank you. Looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that any trade that you take obviously has risk. So you want to manage risk in a way that makes sense to you from a trade side perspective, stop loss, whatever method you're using to manage your risk, you want to consider that before you place your trades. Obviously, the flip side of that is that each trade has a good potential for profit as well, and we'll go after those profits in the best a way as possible. And keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now, real quick, what is fundamental analysis before we get on the live charts? Basically, it's looking at the news. Different types of news could be from an economic calendar with scheduled events. Could be some sort of extraordinary news that comes across the headlines unexpectedly. But we want to consider all these types of things and how they affect the movements on the charts for the instruments that you plan to trade. And basically, that's what fundamental analysis is. And it makes sense that you combine that also with technical analysis to pinpoint entry point and exit point that you prefer to see if the timing is right yet. And the fundamental news typically is determining the direction that you want to trade, and the technical analysis may be the intricacies of where you get in and out. Now, you can use our mobile app, AvaTrade Go, and it has all of the same tools that we're about to use in the web trader. So just that you're aware, AvaTrade Go has the free signals, it has the market buzz, it has all of the tools that we're about to use, the advanced economic calendar, etc. And so you don't have to be on a PC or a laptop to make use of these tools, although that's what we're doing now. We're using the web trader version. So if you log in here in the upper right corner of our website, you'll be in our web trader, and you can switch between your MT4 accounts, your MT5 accounts, your live accounts, your demo accounts, right in this location here, okay? And so what's the fundamental news situation right now? What we need to do is go back and look at what's happening in terms of announcements that occurred yesterday. I have one participant saying that they're not hearing me, that there's no volume. So I'll just ask everyone, type OK if you're hearing me clearly still. It could just be the one person that doesn't have the audio on their side. Sound is okay still, everybody? Okay, so it's just the one person who's having audio issues. Thank you. I can see everyone's okay. Let me just let that person know. Okay, so I let that person know. It's just that person. Okay, Stein, good. I'm glad you can hear now. You must have had something on your side with an issue. All right, so back to what I was saying. This week, we had some news come out of the U.S. You all probably saw the reaction of the market. The Dow Jones, the S&P, and not just U.S. indices, but European, Asian, they all were hit. Huge sell-off. A number of commodities dropped sharply. The U.S. dollar strengthened sharply, and it was simply from, and I can show you what caused it. If we go to the economic calendar, and you could have been trading on this, by the way. I've shown the strategies of how to use this economic calendar to trade on various announcements and to help predict what direction it would move. So, if we go back a couple days, let's see, was it Tuesday, I believe? The U.S. had core inflation rate, okay? It was expected to drop from 3.9 to 3.7, and it stayed the same at 3.9. So the inflation rate came in higher than expected. The month-over-month inflation rate went up. It was expected to stay the same, and it actually went up to 0.3. So, when you gain 0.1 on an inflation, month-to-month inflation of 0.2, that's a 50% increase compared to what was expected, right? If 0.2 goes up by 0.1, that's a 50% increase. So it might seem small coming in at 0.3 instead of 0.2, but trust me, the market read this as a big deal. The core inflation rate also was expected to stay flat and went up to 0.4%. So across the board, the numbers were higher than expected. Core inflation rate year over year, core inflation rate month over month, and inflation rate, which doesn't exclude the energy sector and those things excluded in the core inflation, also went up. Okay, so only one of these numbers, the year over year inflation rate, stayed the same, but the core went up. So that caused a huge reaction on the markets, and you're able to check, what has been the reaction in the past. Like if this was Tuesday and you're looking at this and you're saying if this came in above forecast, what could be expected? You can look at data for different currency pairings. Below forecast, expect it would be more of a rise than a drop, but above forecast, you'll see on a number of these data points, you'll see that it's predictive of a strengthening USD when the inflation rate comes in higher than expected. And you might say, why? You might wonder why if you're not familiar with this data, and wonder, high inflation means your currency is becoming weaker. I mean, in general, that's what it means. You need more of your currency to buy something. The price went up. So instead of $5, it costs $7. So your dollar got weaker. You need more of them to buy the same thing. So higher than expected inflation, in a general sense, typically means your currency is getting weaker. And so the question is, why then did the USD rapidly strengthen when the inflation rate showed higher than expected? And the answer is not because of the inflation rate, but because of what people expect not to be done because the inflation rate went up. And that is the expectation of rate decreases in the US went away, because with higher than expected inflation, the idea of lowering the interest rates back down, which loosens up the money even more, which could lead to even more inflation, that idea went out the window for maybe this next quarter or even longer for many analysts. So the prediction now is the US is less likely to lower interest rates anytime soon because of those high inflationary numbers. The higher interest rates were supposed to bring inflation down by strengthening the currency. So it did. Inflation was above 10%. Now it's down 3%, 4%, but the target is 2.5% or somewhere around there. So it's still much higher inflation than is ideal in the US. And on top of it, it just went up instead of down with those numbers Tuesday. And so everyone who was counting on multiple rate decreases this year to make doing business cheaper business loans, cheaper home loans, cheaper car loans, etc., lower credit card rates, the fear just came back that, hey, those rates aren't going to come down anytime soon. And so there was a sell-off on the equities, meaning the stocks, the major indices. Gold came down as the USD strengthened, etc. And the euro dropped against the USD. The pound dropped against the USD for the same reason. That was Tuesday, huge move, okay? And now we come to a couple days later, and we look at, well, what data will be coming out today? And so there was already some data out of Great Britain, GDP numbers that missed the mark, okay? The gross domestic product out of Great Britain was expected to drop, but not into the negative. So it was expected to drop month over month from 0.2 to 0% growth. And it actually reversed and went negative, okay? In fact, this is kind of what the US maybe was hoping, was to get weak numbers coming in economically to justify lowering the interest rates finally. But it was the opposite in the US. In Great Britain, the numbers came in worse than expected on GDP growth rate quarter over quarter, on GDP growth rate year over year, etc. Really weak numbers, GDP shrinking. And so you would expect that could that's a sign of less demand. Maybe that could mean inflation could come down easier in Great Britain, less of a need for high interest rates, etc. And so there's reason for, with that type of news, for the pound to be bearish potentially. And we could check the past data when things come in lower than expected, which way does it move? But in general, that's the trend. As you get bad economic data, currencies tend to weaken. As we scroll down then, and we say, well, what about the US then? Because all eyes are on these upcoming announcements, the next major announcements coming out, retail sales, jobless claims, Empire State Manufacturing, industrial production, all coming in today, all high-level announcements. What we know is this: just the slightest bit of fear about, hey, interest rates can't go down because this data came in stronger than expected, caused a huge crash Tuesday, okay? Huge sell-off. So the markets have actually bounced back up since that sell-off. Not all the way, but a good chunk of bounce back up on the equities, the commodities, etc. Okay, currencies have gained back some against the USD, the euro, the pound, etc. Now we're in a situation where if any of this data, or if the preponderance of this data coming in is better than expected, we could see a repeat, or at least in the same direction as what happened Tuesday, from better than expected data. Okay, there's no guarantee, obviously, but we can look at just the idea that there are large announcements. Let me show you what's been happening recently in the past. So we can look at retail sales month over month, okay? And we can say with the Euro-USD pairing, we can look at any USD pairing we want. We'll go 4 hours after the event. We could do smaller time periods. Let's do 4 hours. And if we look at all of the events, doesn't matter if it comes in better than expected, worse than expected. Look at the fear that surrounds these announcements in the hours after the US announcements. 75% of the time, the USD pulls the euro down with an average range movement of nearly 57.4 pips. It's a large range movement in a small period of time. And look, almost all of them are down with just a few up, okay? If this comes in above forecast, okay, 57% down. If it comes in below forecast, 100% down, okay? So even bad news economically with retail sales, USD is strengthening, okay? That's what the history shows. What about manufacturing data? All events, USD is strengthening after this announcement, 67% of the time. If it's above forecast, okay, 50-50. Below forecast, 83% dropping. So it looks like with these announcements right now, if they come in with bad economic news, remember, these are not inflationary data. The inflationary data showed higher inflation than expected. But the non-inflationary data, the economic data that's showing production, retail sales, all of this, if this is coming in worse than expected, that's where we're seeing a larger percent drop. Okay? The opposite of the inflationary data. So these announcements are speaking to the health of the economy. The inflationary data is another thing. It's showing that prices are going up, which created fear when they were higher than expected. What's creating fear with these announcements more, and we saw a larger drop when the numbers came in worse than expected. For retail sales, a larger drop. We saw 80-something% drop if the manufacturing data was worse than expected. We can look at jobless claims. If they come in below expectation, 63% of the time it drops. Okay, above expectation, 75% it drops. So with the jobless claims, it's regardless of whether it's good news or bad news, there's dropping, and that's probably related to the fact that these are at the same time. And when there's been poor economic data, the U.S. dollar is strengthened as people leave the equities again. Okay, leaving the stocks and the major indices, et cetera, and the commodities. So it's hard to get a handle on if these come in better than expected or worse than expected, what might happen, because for some of these, regardless of how they come in, the USD is strengthening after these announcements. And it's because there's just so much fear out there about the interest rate situation, and is there a recession looming with the inflation staying high for so long? And so It's almost like whatever data comes out, and it seems even more so if the data with these particular announcements are worse than expected, that you see another rapidly strengthening USD. Okay, so I think there's huge potential here to stimulate more of the fear that we saw on Tuesday. Okay, now it's possible they come in the flip direction and they go the wrong way and they rise if you were selling in this situation. But you can hedge your risks. You can have a measured risk per trade in that situation. Okay, and if we go all the way down to industrial production down here, the last announcement of the day, again, 2/3 of the time on all of the events, there's more dropping than rising. If this comes in above forecast, 67%, it drops. So the industrial production is the same, acting the same as that inflationary data from Tuesday. If the industrial production comes in higher than expected, it drops 2/3 of the time. The USD strengthens and pulls the euro down. So you could wait for that industrial production announcement being the last announcement after all the mess of announcements here. This makes it more confusing with all of those announcements at once. This one stands alone later on. And it's clear that if it comes in better than expected, 2/3 of the time, the USD strengthens. Okay, and so, and if it comes in worse than expected, 60% drop. Better than expected, 67% drop. So stronger percentages for dropping with when the numbers come in better than expected with industrial production. So we can start to look at these statistics from the past with different announcements. Some of them are in the 80% certainty range from the past based on how they come in. Some of them are more 60-30, 65-35, etc. So you pick the ones that you feel most confident about, and when you see the numbers come in, you can make your move. Okay. Now you also can preemptively think about the overall fundamental news situation, and that is there's a lot of fear on the markets. There was a huge crash on Tuesday, followed by a typical bounce over the last day and a half or so. And so now we could start to look at the same instruments that had those big moves and see if there's a possible entry point that you might like. Okay, so let me get rid of some of these lines I drew. We don't need all of them. Okay, so what are we looking at here? We're looking at 2-hour candles. And I drew at the top there resistance levels. And it looks like the resistance levels are respected again. So here's the drop from Tuesday, right here. It broke the support level. You see this was support, 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 support earlier in the week. The announcement came in and boom, down went that support. It broke the support. We went over concept of having a pending order below the support level prior to the big news, so that if it was news that caused fear, which sometimes it does with CPI data, if it broke the support, your pending order down here would have triggered, and down you go with a big profit. Okay, putting pending orders below and above key price levels of support and resistance right before major announcements many times can pay out like this, because it takes big news to break those support levels many times, and when they break, the momentum carries the movement some distance, like Tuesday. Okay, now we see the bounce back up. Here it comes back up, and predictably, it found the old support level. It's not by accident that that's where it stopped rising. The old support, once broken, becomes new resistance. Okay, that's a technical strategy. So now we're looking at the fundamental news situation, being that there's an air of fear still out there. We have the potential for the fear to return if those announcements out of the US today come in a way to cause fear to go back up. And we see from the past, almost regardless of how those numbers come in, those announcements create some fear on the markets and a strengthening of the US dollar from the past statistics. Okay, not 100% of the time, obviously, so we want to manage risk. But from a fundamental perspective, it seems that there's some stimulus for more fear later today with those announcements. And if you look at this entry point from a technical perspective, wow, is that opportunistic? What I mean by opportunistic is we are just below this resistance level, and the only way for it to break this resistance is if it has enough momentum, like it had momentum here to break below it. It needs momentum to break above it. okay? So it could easily drop with fear, with renewed fear. To get enough positive momentum to overcome the news from Tuesday seems harder. And our stop loss doesn't have to be far away, so we can risk very little to get beyond that resistance level with our stop loss. If it breaks through, okay, must have been momentum the other way, I'm out. I'll take my small loss. But if it goes the right way, look how far it can fall before it reaches the support level from Tuesday. Okay, so this is an opportunistic setup from a technical perspective. The resistance level is close and the support level is way below in a situation where the fundamental news says maybe it might make sense to sell. Okay, and so this is how you use different tools like the economic calendar, looking at the past data on the economic calendar with the tools that were used on it, paying attention to economic announcements from earlier in the week and also the upcoming economic announcements, and then combining that with your technical entry points and exit points. This takes those tools and creates a strategy. If I looked at this and this had already dropped and was sitting down here on the support level, then I'd say, okay, I'm late. You know, the fundamentals tell me to sell, but if it already dropped and was on the support level, then I would need a different strategy, because then I wouldn't be in such an opportunistic entry point. But because it's an opportunistic entry point right now, I can do a market move. I don't have to do a pending order and wait for it to get into an opportunistic spot. So what I can do is say I want to sell. I can put my stop loss just above this resistance area up here, maybe here, above this little notch here where it dropped off. Okay, just have to not just break through this resistance level, but it would have to go above this high point to hit my stop loss. So 5,043, I'll put it. Stop loss, 5,043. Okay, then take profit. I don't even want to have to wait for it to break Tuesday's low. If it approaches Tuesday's low, let's say 49.50 right here. Okay, nice round number, 49.50, without even having to challenge the low point from Tuesday. I won't be greedy, I'll take profit at 49.50 as an example. Okay, so 49.50. And now we look at the opportunistic nature of what we just did. We've got our stop loss up above two resistance levels. This resistance here, which was the support, and then up above this resistance here is our stop loss. So we're up above two resistance levels, right, with our stop loss, and we're still only risking 2,700 compared to 11,250 potential profit. And we're taking profit without having to break any support levels. We're taking profit before the low that it was at just 2 days ago. Okay, so this is what I talk about from a technical perspective as being an opportunistic entry point. Small risk, larger potential profit. The risk will only be realized as a loss if it breaks through two key price levels, and the profit can be realized without having to break any big price levels in terms of support, okay, or resistance. So what we're looking at then now is how much do I want to risk with this setup? My entry price, my exit price for stop loss and take profit, it's all set up now. Now I just need to adjust the trade size for this setup with my stop loss here and my take profit here. So I want the right trade size that I'm risking the amount I want to risk. And if I want to risk a certain percent of my balance, then I can adjust the trade size now until it shows that as my possible loss. So let's say I want to risk, I don't know, 700 on the move. So which is around 1% of my balance, a little bit more. Okay, or I could risk 666, right? That sounds like a bad luck number if you're superstitious, but that would be closer to 1% of my balance. Okay, so you figure the amount you want to risk, and then you adjust the trade size for whatever setup you have to meet that risk. So here's 450 risk. Okay, I can go to 0.4. I'm risking 720. I originally said I would risk maybe about 700. So 0.38. Now I'm risking 684. Okay, that's somewhere between 1% or a little above, right? 1.1%, somewhere between that range with that trade size. If I'm comfortable with that, risking a hair over 1% of my balance on the move, then I go. Okay, now I'm ready to set the trade in motion. And that percent is different for everybody. Do you want to risk 0.5% per trade? Do you want to risk 2% per trade? That's up to you. But you should know the risk going into the move. Don't guess a trade size and don't, you end up placing the trade without checking what your risk is. You really should understand the risk going into it. So all is good. I place the move, okay? And you don't have to agree that you want to sell here, but it's a concept that I'm showing you, that you check the fundamentals. And if you read the fundamentals like I did, that I think there's a lot of fear there still, and the potential for more fear based on the announcements coming and based on the statistics, more times than not, those announcements cause the USD to strengthen, regardless of how those numbers come in some instances. So if you start adding up the statistics from past movements and the opportunistic entry point from the technical side, and you put the pieces together, if in your mind it says sell, then you should sell. If in your mind it doesn't, then you don't. Okay, but my point here isn't to tell you which direction you should trade, but to show you the process that you can go through to then determine that for yourself. Okay, and in this simulation, it made sense to me that the tea leaves kind of came together to tell me sell could make sense here from a fundamental and technical perspective. So stop loss right up in this area, 5,043 or so. Take profit down here, 49.50. I don't know, better than 3 or 4 to 1 ratio. I only need to be right 1 out of 4 times and I profit on a setup like this. Okay, 25% success rate could be a nice profit still. Okay, so when you start to look at things that way, you can start to think just statistics without putting emotion into it. The statistics showed on the economic calendar that more times than not, those announcements caused the euro to drop, and you also could look at the S&P 500 paired against the euro because it moved the same on Monday. So whether it's the euro USD, we could be following the same strategy as what we just did on the US 500. Okay, so and you can do the same risk profile. So I know the economic calendar is only analyzing the currency pairings, but you saw a relationship on Tuesday when the S&P 500 and the Dow Jones were plunging, so too was the Euro USD. What do they have in common? They're all paired against the USD, and it was the strengthening USD that caused them to drop in unison. Okay, and so here's the look at Euro USD. It looks just like the S&P 500. We could have done the same thing as that trade I just simulated on the S&P 500. Here's the support level right here from before the announcement. Could have had a pending order down here. The announcement comes in, it breaks the support. Boom, would have triggered your sell pending order by breaking the support. Down it went. Here's the bounce back up. Here's the resistance level being found a little bit lower. It's not as pretty as the S&P 500 one. What did I just do? That's not what I meant to do. Let's expand this chart. Sorry. And let's bring back up the Euro USD chart. Go back to the trade area. Apologies. I got a little carried away clicking on things. There's the Euro USD. There's our chart. There's this broken support. And it didn't come up. I was trying to get my line drawing tool and I clicked on the wrong section. Okay, let's put another line. This is where it came up to. And that matches this resistance level here. Okay, it's not a coincidence that that happens. This in the past hit this price and bounced. So this bounce back after the crash down worked its way up to the first resistance level and stopped. Okay, right in line with this old support level. So yesterday it broke this support and then broke another support, and then the bounce back didn't make it to the first one like the US 500 did. It only made it to this the second support level that was broken here. The S&P 500 picture came up to the original spot that it dropped from. Euro USD didn't even get that high. Okay, so I like the US 500 set up a little better technically, but fundamentally this is the same idea. You could say that you want to sell. You could put your stop loss just above the first resistance. To be safer, you could put it above the second resistance level for a stop loss, which would make you have to risk more to have your stop loss above both of these. But one or the other, stop loss somewhere up here. Take profit if you think the USD will strengthen again. Take profit could be down here near the support level on the Euro USD. Okay? I don't need to walk through actually placing that trade because we did that already with the US 500 over here. Okay? Any questions, comments on what we covered? I'll pause for a moment. Okay, let's look at another instrument. I don't see any questions popping up for the time being. We could check out something like gold. Okay, and we see gold, same as the other instruments. Here's the drop with the announcement from Tuesday. Here's the bounce, much smaller bounce on gold. So again, not as opportunistic as the S&P 500, that the bounce came all the way back up to the old support level. Gold barely bounced. It did not come back up very far. It actually found resistance at 2,000. Okay, just a round number caused resistance rather than an actual resistance level. This is a round number, and many times round numbers like 2,000 even act as resistance in traders' minds. And so it's a self-fulfilling prophecy. If people say, oh, I think it'll climb back up to 2,000, once it gets there, they start to sell. So we see gold just sitting here. Again, I don't like the entry point as good, but it's the same pattern. And we can look in the bigger picture maybe on gold. Okay. If we look on gold here and get rid of some of these lines that have clouded up, when you go to 1 week candles, all the lines you drew on the 15-minute candles look like they're all super close together. So let me delete these. Okay, if indeed the USD is going to continue to strengthen, if there's more and more of a realization as more data comes in today, tomorrow, next week, that wow, they're not going to lower interest rates anytime soon because inflation is still rising instead of dropping, then you could foresee a situation where the USD could strengthen enough to pull gold down to the next support level. The next support level on the 1 week candles is down here around 1950 or so, 1940. Okay, I drew these lines for a reason in the last webinar. I thought that if the USD strengthened, it could head that direction. Well, it made a big move and headed that direction some already. You could have already taken profit, but it looks like the next support level in terms of the 1 week candles, let me just get rid of that second line. It's right about here. Okay, you see 1 week candles hit once, twice for 2 weeks, held. That's a long period of time. It's not like we're looking at 15-minute candles here. For 2 weeks, the price tried to break below 1924, tried once, tried twice for 2 weeks, and then went up. So if this is going to drop further with a strengthening USD, you could be looking before this support level, which is 1924, to think about taking profit. And that's where that second line comes in. You draw just above the support, and I drew that one at 1935, for example. So if indeed you expect a strengthening USD, you could sell on gold, okay? For a longer term move, okay, you could go even lower. 1800, one of these support levels down here, okay? That's 1819, 1820, this next support level. So it depends whether you're scalping. You could just do a short move here. I say short, that's about $60 an ounce down to this support level, still quite a distance. Or you could do a longer move, depending on if you think, some analysts think that the US might be showing higher than expected inflation all the way till summertime. And if that's the case, if the data keeps coming in like it did Tuesday, causing the USD to strengthen again and again, you could see gold work its way down to this next support level around 1819. So this is a fundamental news type trade that's more macro, okay? By macro, I mean larger time frames, larger idea of monetary policy, that now it seems they're not going to raise interest rates maybe for another quarter or longer. And if that's, or I mean lower interest rates, maybe for another quarter or longer, which was not expected as the year started, okay? And so there could be potential for gold to pull down if the USD continues to strengthen with the fear that interest rates will stay high. in the US. So this looks like, from a large macro fundamental perspective and from a technical perspective, that you have two price targets here if you think gold will drop from the fundamental situation on monetary policy in the US. So 1935 and 1820 are two price targets I see as potential support levels to take profit if you think the USD will continue to pull commodities like gold down. Okay, and I think it's an absolute possibility that that could happen. Now, short term, gold could also push down with today's announcements. I mean, I know it didn't bounce up as much as the S&Ps, but it was down to 1984, and now it's at 1996. That's about $12 an ounce. Okay, you could do a move like with AvaProtect if you wanted. You could do a move without, just with a stop loss. On the 5-minute candles, it looks more pretty. Okay, resistance sitting on top here. Maybe you put a pending order that if it breaks back below this little resistance that it's above now on the 5-minute candles, if it breaks, you could have a pending order here to sell. Or another option, if you think gold could spike up before it drops, but you still want to sell and you don't want the risk that it'll hit your stop loss, you could use AvaProtect. Okay, you can put protection on the trade. It doesn't matter how far it goes the wrong way. Your losses are covered by the protection, and if it goes the right way, you could make a huge profit. Okay, and you could protect it for a couple days, all the way to Monday from today, 2 business days, and you could have a huge potential for a big move. And if it goes the wrong way, well, okay, you're covered. Just the cost of the protection during the protected time period. So if I start looking at 4-hour candles, and by the way, I keep saying sell. If you think it'll go up, if you think this was an overreaction with gold dropping, and you like the support level down here, by all means buy on gold. Maybe gold goes back up to 2080 up here. I'm not telling you it won't. I'm just explaining the fundamental news is why gold dropped, the fear. And if that fear continues, it could drop further. But regardless of whether you want to buy here or sell, you can do it with AvaProtect through these announcements today. Protect it for 1 day, 2 days, with a potential for a huge move. And if it's the right direction, you make a lot more than the protection costs. And if it's in the wrong direction, you only lose what the protection costs. Okay, so I'm going to protect it on a sell as an example. Okay, you could protect it on a buy if you wish. I'm banking on more fear, and if that happens, I think gold could drop. But obviously, I could be wrong. Now, I want to protect through the announcements only. 6 hours protection will do. If I want to give it a couple days, even through the weekend, to drop, then I do a couple days protection. Obviously, it costs more the longer the protection time period. I'm going to do 2 days protection. I'm going to say bigger macro view. I'm not going to go for the 1820 support because that could take longer than my protected time period quite easily, right? But I think it could reach this support level within my protected time period. So 1935, so I'm going to say 1938 if 1935 is my support. So 1938 take profit. Okay, wow, almost $30,000 potential profit. Cost me $4,800 for the protection. Again, I don't necessarily want to risk that much. I don't want to pay that much for protection. So I'm going to try a smaller trade size, 0.5. What does that cost me? Less than 500. Okay, 0.55, 0.6, 0.65. Okay, now I'm getting closer, 0.68, closer to 1% of my balance. Maybe 0.7 will do it. Okay, 0.7, about 1% of my balance, give or take a little, for the cost of the protection. My potential profit over $4,100. Again, if I'm right, 1 out of, 8 tries with this, I can profit because of the cost of the protection compared to my potential profit. And we saw how much gold moved in the past few days. It easily could move that distance again. Okay, we know it's possible. It's not like it's too big of a concept that it couldn't drop another $60 an ounce or so. So I set that trade in motion with protection. So now I'm diversifying my risk management as I use the fundamentals to steer the direction of the trade, okay? And again, each trader can read the fundamentals different. My point isn't to say you should read it that you should sell on gold right now. My point is, however you read the news, however the fundamentals set in your mind, and you pick a direction that you think the movement should go, then you can protect it in a way like I just showed you, okay, with AvaProtect. And AvaProtect, I like to use it when I know there's high volatility and I'm uncertain of the direction. So the more uncertain I am, but if I'm certain of high volatility, meaning big movements, but uncertain of which direction, AvaProtect is perfect. Because if it's a big move the right way, I get a big payday. If it's a big move the wrong way, I'm only risking the cost of the protection. And I can be patient all the way to Monday with my protection to see, even if it goes the wrong way initially, maybe something happens over the weekend that on Monday it goes my way. And with a stop loss, I'd have been long out of the trade maybe. And with the protection, I can be more patient because I'm not risking anything more to let it keep going, okay, during the protected time period. Okay, any questions on anything? I think this is a good place to stop. We could look at crude oil. I do see someone requested that. Okay, crude oil was interesting because when everything else was dropping, crude oil was going up. And the reason is obvious, right? If there's higher than expected inflation, and you know, crude oil is one of those things that is a must use, right? So it's not like people can just say, well, then I won't drive to work and use it less. You know, people can sell their stocks, and that's why stocks drop, but they can't not use oil. They have to buy gasoline. There's always demand for crude oil. And if the currency is kind of strengthening against other things that are selling off, those people are looking for something to buy when they're selling their stocks. So they're not only buying the US dollar, but they're saying, hey, if there's higher than expected demand in the data out of the US showing the economy is stronger than expected, then that should drive up demand for something like crude oil. And so crude oil was one of the exceptions. It was climbing while everything else was crashing. Okay, if we look at the 2-hour candles, we can see that it did the exact opposite. Okay, crude oil went up, broke the resistance and climbed, and then pulled back. The others dropped and pulled back up. This went up and pulled back down. So the exact opposite. We're sitting on top of a support level after a breakthrough climb, and this looks like something that is set to go up if it doesn't break the support level. So this is the exact opposite of the others. We're looking at stop loss below this support level down here. Stop loss down here below the support if you think it'll go up, okay? I'm not telling you you should think it should, but technically that's a nice support level. And the news from Tuesday drove crude oil up. So if that same sort of sentiment comes back, crude oil could push back up again, okay? If there's stronger economy than expected, if that type of data comes like Tuesday, you could see this push back up towards 78, 80 a barrel again, okay? So if that's how you feel about it, then you could buy stop loss down here somewhere below the support for a small risk, and look how much more potential profit you have compared to risk if you take profit even before yesterday's high, okay? So you could take profit at 78 and you're making over $2 a barrel and risk only maybe 50 cents a barrel to get below the support level. Okay, it looks like a nice technical setup to buy. And it seems the fundamentals could work with that potentially today like they did Tuesday. Okay, I'm glad you requested oil. That was a good one to look at as well, to show the opposite reaction in something that was climbing while most everything else in terms of commodities and indices and other currencies were dropping against the USD. Okay, I think this is a good place to stop. I don't see any questions that have popped up. So good luck with your trading. Maybe you make some moves that make sense to you from what we covered. A lot of data coming in today. I think you'll find some good opportunities. All right, everybody. Bye for now.